Welcome back. You're watching HFO-TV.
Welcome back to HFO-TV. I'm Greg Frick, partner at HFO Investment Real Estate. And today we have with us Doug Blackwell, Vice President of IPX, a national 1031 accommodating firm. Thank you for coming. We're going to get a little update on the changes for 1031 exchanges that came from the 2018 Tax Cut and Jobs Act that got just passed and now is in place now for 2018. So again, thanks for coming.
Greg, it's great to be here. I love doing these types of pieces to get the information out in a manner people can stop and rewind and listen again, because it gets kind of long-winded sometimes. So I really appreciate to be here.
So I know, previously there has been talk of getting, 1031s being taken to the wayside and getting rid, and that didn't happen in this. So they did make some changes, but it wasn't the drastic changes that, I think we talked a couple of years ago about, maybe they're going to go away. So maybe we can just kind of give a little rundown on kind of substantially what the big changes were from where we were last year to what we're going to be now in 2018 and moving forward.
And one of the blessings that we did have, Greg, is before, we were always challenged with, is 1031 going to go away? And we were very fearful of it.
Yes.
And what they were going to replace it with was kind of even more scary to us. And luckily, they didn't take away 1031 exchanges for real estate, for real property. They left that alone and intact. What they did change is that we lost the ability to do personal property exchanges. And in that, many people look at it as a negative. For me, as I've been sharing with many of my clients, it's actually presented a huge positive. And I'd like to cover a little bit about that, because it's not a 1031 exchange anymore. It's a personal property purchase, where it used to be an exchange.
Whereas a lot of our clients are in real property, multifamily, the 1031 was always conceived, it's for real property. And a lot of them didn't even really kind of realize that there was a personal property or other asset types, components of 1031. So that's really what's changed. And they kind of left the real property side alone.
Correct. All the real property were golden. Still the same rules. 45 days, 180, invest equal or greater value, like kind property, it's all real property now. So what's going to happen basically, and before we do, I do always give my full disclosure, everything about the new tax law is new. And we don't know everything about it. And just as much as I want to drive 55 and a 55, I'm always going to drive 65 and a 55 and push it a little bit. I always encourage people to check with their tax advisors before they do anything, because we don't know all the answers to what may be happening with them or this new tax law.
There's no case law, there's nothing there that's going to set a precedent, so
So it's pretty clear what it is. But what's interesting though, the personal property side of it, looking at that, it's no longer exchangeable, which is a blessing in that it used to have to be like kind property. And that's what made it very unique. If I sold a restaurant and I wanted to exchange the personal property, which was the pizza ovens, the furniture, and maybe the mixing tables, we had to buy pizza ovens, mixing tables, and furniture.
So like it's not restrictive on the like kind property, on the personal property side.
On the personal property side. And what's interesting now is that with the personal property, if done correctly on certain assets, and I do believe there's going to be assets that are depreciated on a 20-year schedule or less, that these assets, much like equipment, the trucks, the pizza ovens, the things like that for the business that's being used for productive use, we can now what's called immediately expense against capital gains, taxes, depreciation capture, and also some income. That's a really big opportunity for a lot of our clients, because maybe they're not going to do a full exchange. Maybe they need some offsets. And it's not going to always be for a multifamily, maybe not for an apartment complex, but believe it or not, apartment complexes have a tremendous amount of personal property.
That's right.
We have refrigerators, we have stoves, we have you name it. And what's also a blessing in this, the immediate expensing used to be only for old equipment. I mean, new equipment. Now we can also purchase used equipment in that model.
And put that in the expense side.
On the expense side.
Wow, okay.
So it's one of those pieces that is going to offset gains that we may create for ourselves. And I like to use this as an example for simplicity purposes. I've done no less than a dozen conversations a week on this topic for the last 3 weeks. It's just becoming very important to my clients. An example would be, I need to buy a piece of real estate, but it's not as large as the one I sold. I sold a $500,000 asset, and I'm only buying a $450,000 asset. I have $50,000 in capital gains and depreciation taxes that could be due. Well, if they're going to be buying personal property with that $50,000 after the exchange, they could offset 100% of the taxes against that tax liability.
So use the personal property as the purchase to offset the boot that's left on the exchange side.
Or if they want to purchase the personal property after September 27th of 2017 going forward, if they've already purchased the personal property, they can immediately expense that against boot created from a 1031 exchange.
Okay, so
And
that's the big difference.
That's huge. That is it. But to make sure we understand it also, it's only a sunset of 5 years on that one.
Okay.
They don't know the impact that's going to have on the federal government. They don't want to commit to it long term. So it's a 5-year window on it, and they're going to phase it out over the next 5 years. So it's something you want to check with your tax advisors on before you
so
proceed.
the initial is a 5-year change, and they're going to see what the effect is, and then there could be there probably will be changes.
There probably will be.
Yeah,
Yeah.
and then what's going to happen after that.
Correct.
Got it. Okay. So that's a big difference. Like I said, in our transactions in multifamily, predominantly, there's just kind of this assumption: oh, I'm going from one apartment to a next. I'm going to exchange the real property, and the kind of personal property is just kind of thrown in there. And the idea being, if something were to happen, I've got personal property that I bought refrigerators, and probably more. So
probably more.
yeah. So this is going to be a little bit of a difference where, in theory, that personal property component's not part of the exchange. It's the real property, and then we'll do the real property.
It's a better deal. I think personally, it's not even like kind. You buy any personal property. It doesn't have to be pizza. You want out of the restaurant business, get out.
Got it.
So that's kind of my point.
So now back in the day when they were doing personal property exchange, when they said like kind, because in our world, in commercial, in the real property, like kind, just as long as it's not a single family, as long as it's not your residence.
Right.
Land counts, this, retail, office.
Real estate for real estate.
Didn't matter. Yeah, so they're much more specific on the personal property for like kind.
It's even down to the same sex. We do a cow for a cow, no bull. It has to
Really?
be, it's that specific. That's why like kind was such a big deal, but in us as in the real estate side, it is just real estate for real property.
Right.
Now it's not like that, it's just,
So they kind of just got rid of that whole kind of.
that's all gone. Another piece also, Greg, so I don't miss it, and because I really only talk to my sophisticated commercial folks, and you guys are obviously one of those groups, the Section 179 expensing also.
Right.
That's a big deal that changed as well for us. That one used to be a 3-year hold on a lot of those write-downs, and now it's immediate upon when you put property into production. That one is something you definitely want to check with your tax advisors about, because we want to make sure the assets that you're putting on the 179 is something that qualifies for it. Right. The roof, for example. Tenant improvements, leasehold improvements are now immediate. It's not something you have to wait 3 years for.
So you get the immediate write-down right away.
As soon as you need to do it. And it's important those values for the next 5 years, I see a huge opportunity for our real estate investors to be able to take advantage of that and improve their results, because certainly they're going to have a hard time raising rents, but they certainly get better write-offs and offsets from those assets right now.
Now, is that section sunsetting also in 5 years?
That one I'm not quite certain about, but I'm going to say yes, because it's a tremendous. They also moved it up from $500,000 limitation to $1 million limitation.
Right, okay.
And they're talking about taking it even higher over the next years.
Oh, they are.
So again, it's one of those. It's work in progress on that one.
Interesting. Any other big kind of substantial changes in your world on the 1031s with this, the Tax Cut Job Act just passed?
One last one that a lot of our clients do enjoy paying their taxes, which is fine, or they know they're going to pay taxes. Is starting in 2019, the net investment income tax.
Right.
That one's at 3.8% for people with incomes of a single 200,000, married couples 250.
Got it.
Your capital gains created by your sale is going to be considered income for that calculation. You're taxed at 3.8% on that. Starting in January 1st of 2019, that tax is going to be reduced to 0. It's not going to be eliminated, because they're probably going to want to bring it back. They won't have to vote it back in, but they're going to reduce the tax to 0 starting January 1.
So they're not eliminating, so it's still in the books, but they're just going to...
It's going to be 0 for now.
Got it. Okay.
And so that one probably is going to come back. It could. But someone wanting to pay their taxes could wait until January 1 and save an additional 3.8%.
So structure your deal where you've got a close or an exchange and put you over into the next tax year in 19.
Correct. And I tell people this all the time. It's real important, if you have a buyer in this marketplace and you have someone willing to close, able to close the deal and use the 1031 to drop it the next year if you can. Because there's no reason to lose your seller. Or buyer. There's no reason to stop the deal. We can move it for $950 or less with a 1031 exchange into the new year.
So for people to understand, the close date's not so dependent on what the close date year is. It's if you do an exchange, close in October, do your 45, do your exchange and put it in, it's going to put you into the next year.
And actually this year, 2017, to make it perfectly clear, had you opened your exchange on November 17th or later in 2017,
45 days.
The 45 days dropped you into January 2nd of 2018.
Got it.
So we effectively moved all those closings that happened that last quarter into the first quarter of 2018, allowing them to take advantage of all these new tax laws.
Right. And again, you don't have to complete the exchange. You just have to start the exchange, set it up with an accommodator like yourself.
And it should be the intent of a reinvestment. Try to find something,
Try to
but
find something. But if you don't, and your 45 days puts you in the next tax year, it's as if the sale's closed in that tax year.
and again, you have an option which year you pay those taxes. You work with your advisors on that.
Right. So I guess the big thing is a lot of changes have happened this last year.
A lot.
Coming forward, as I mean, if you talk to your CPAs, you know, it's not only just in 1031s, it's kind of the whole tax code in general. Make sure you talk with your CPA to get an idea of what's going on and see if there's some benefits. But this whole personal property versus real property and the immediate write-off, I think, is a huge, huge benefit, which can get a little bit more creative.
And I'm advising a lot of our clients to take advantage of it. Do not do the exchange. Take advantage of that opportunity. I'm not getting paid on that one, obviously, but it's in the best interest of my client. But what turned around is that more of my clients are actually willing to sell now knowing they can do this, and they're doing partial exchanges. They're taking a chunk of the money and doing what they need to with it and exchanging the rest,
So
where they
you're not
couldn't do
feeling
that.
pressure of I need to get, you know, I've got an asset for $2 million, I've got to find something in it for $2 million. Maybe I do $2 million and take 500, and I go buy something for $1.5 million, and I can find some offsets for that 500,000.
That 500,000 offsets, you got it. And one thing to also remember is that you can't depreciate the assets you immediately expense because you just depreciated at 100% immediately. So you lose a little bit of benefit, but you get a
Down
big
the
one right
road.
front. Right.
But I think, as most people realize, I'd rather take the benefit today as opposed
It's a depreciating asset anyway.
Right.
It's like a laptop. It's going to eventually be worth nothing.
Right,
So,
exactly. Well, thank you for coming by.
Yeah, you
Thanks
bet.
for clarifying that. And we'll see you next time on HFO-TV. Great, thanks. Great. Perfect.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.